All right, well, it's 11 o'clock, so I'll kick off now. Thanks everyone for attending. This is the second quarterly webinar for Glennon Capital, where we'll talk about both the GC1, the listed vehicle, plus we've got a few people on listening in who are invested in our SMA strategy, which is on Hub24, which is a very similar portfolio and follows the same strategy. So here's our normal disclaimer. There's no personal advice here. It doesn't take into consideration your specific personal financial goals. And for those, you'll have to contact your financial planner. Now, this is just the agenda for today. I'm just going to give a bit of an update on the market, what's happening in the small cap market over the last quarter. Then we'll talk a bit about the portfolio, how it's traveling, and some of the performance of some of the stocks that are in there. And our most high conviction investments, and finally we'll cover off on just what we think the outlook is for small companies in Australia over the next couple of months. So I just want to reiterate a little bit for those people that are new, or this is the first time they're listening in, who Glennon Capital is and what we do. And I think I won't spend too long on this, but the key points are, we're a specialist small company investment manager. We're value-based. We do all of our own research. Tim and myself have got extensive experience in the small cap market. Adding together our experience makes us one of the most experienced teams in the country. So going forward a page there. And we try to have a quality theme throughout our portfolio. So moving on, I always put this slide in, when I set the business up. It's all about what we actually believe in. So being aligned with our clients, adding absolute value. We're not that interested in saying that we've outperformed the market and the market's gone down. We all want to make more money. So regardless of whether the market's raging ahead or going down, we want to be adding value in a positive sense. So for those that attended the AGM last year, the directors decided for GC1 that we'd increase the cash weighting that the fund could possibly go to if we took a sort of dire outlook on the market, and that's now 70%. And that aligns us with that philosophy of wanting to add absolute value and be long-term fundamental investors. And why we specialize in small caps, this is a chart we've used a few times, but we do have a micro cap tilt. And just the opportunity set by the number of companies, which is represented on this chart by these spheres here, is just so much bigger in the microcap end of the market. And the Australian market does tend to favour microcaps. It's the vast bulk of companies that are listed. So the opportunity set's huge. There's a huge amount of interest in companies that are out there. I guess our experience helps us cut through the noise of what is, a lot of rubbish companies that are listed, things that are listed too early, don't make money, concept stocks. And I guess that's why most of you have got investments with us. Just if we talk about the review, I think I'll hand over to Tim here.
Yeah, g'day everyone. Look, in the last 6 months plus May, I guess, added to that, the small ordinaries has risen just shy of 9%, so it's been a pretty solid performer. The industrial market's only up 4.5%, and the resources market's been up 23.5%. The global economy is proving somewhat robust now. Some recovery. Oil and gas markets in particular have been strong for resources. We don't have a lot of resource exposure, but we've still managed to keep up and often beat the market in that period. The China-related stocks have been a big talking point over quite a while now in the Australian market, and they had a huge run from October through to January, but then had a pretty serious slump when China-US relations broke down. There was fears of global contagion, and this also affected resource stocks. Those typical names are sort of catching up again. High PE stocks saw a major correction through March and April, and that was exacerbated in the market by a couple of transition portfolios. I think Colonial's shutting their core fund down meant a lot of small caps were flooding into the market, and Perpetual lost a big mandate as well, which also affected the market. The Macquarie conference came along, and I think the confession season was basically avoided, and I think that's what investment managers were fearing. And since then, the market has been on fire. A lot of those high PE tech type stocks, international type stories have rallied very strongly.
So So we'll quickly just cover off on the Hub 24 product, which is a wholesale product. You can only invest in that through financial advisors. But it's probably the strategy we've had running consistently for the longest period of time. These are the top 10 positions. They're very similar to the positions in GC1, so I won't mention all of those because we do go into detail through some of our most high conviction stocks a little bit later on. But what's an interesting statistic that we put together a couple of months ago, but we didn't release publicly, which we're doing now, is that just the performance of that portfolio since 2011, when the market is down. So there's been 30. This chart shows just the negative periods of time since that fund's been running, and so in the 39 periods where there were negative months, that portfolio only underperformed the market in 9 of those 39 months. So it has got quite defensive characteristics. It's because we're not buying rubbish. There's fundamentals behind all of the businesses. You know, when Tim mentioned before that there were a few stocks that were sold off, a couple of our positions were sold off last month for no reason. There was no change in any of the fundamentals of the businesses, and subsequently some of those have rallied back, and that's just having that long-term sort of view on businesses. Is the business traveling all right? You know, is everything all right in their markets, rather than getting caught up in short-term noise and worrying about whether the company is going to beat 6-monthly consensus earnings estimates. So this is the long-term performance of that portfolio. You can see the numbers there are quite strong. It's still performing quite well. You know, the performance has been good over the last 6 months, and a couple of the positions are different in that portfolio to GC1, merely through the legacy that they've been there for a long period of time. If we talk now to GC1, the listed vehicle, these are the top positions. These are the we release these in our monthly NTA updates. We try to be quite transparent with a lot of the positions that we've got there and why we've got them. And as I said, we'll talk in a little bit more detail about some of these positions a little bit later on, but we're reasonably confident with the outlook for the economy. If you've been following the actual individual weighting sizes of some of the positions over the last year or two, our conviction has increased slightly on some of our positions, so the weightings are getting bigger and the portfolio is getting a little bit more concentrated. And I always talk about that as being a little bit of a measure of risk. The more convinced we are of the investment stories, the less that we can have, and we can take bigger positions in those investments as we gain more confidence in it. When we're a little bit less certain about the economic outlook, we will tend to diversify the risk a little bit more and have more positions but of a smaller weighting. This is what the portfolio looks like in terms of the NTA of the portfolio plus the dividends, and I put that in there because I've just come back from the States. You know, I went to the Berkshire Hathaway AGM, which is a company that's never paid out any dividends, and so they get the added benefit of having the compounding on any dividends that they would have paid out. So we show where the investment portfolio would be adding back the dividends that we had paid out. Some people have reinvested those. I reinvest mine. There is a 3% discount on it, so you actually get a little bit better return than this if you do reinvest your dividends. And as Warren Buffett says, you are probably better to take your dividends, reinvest them, and then sell some actual stock. And you know, you're making 3% on that transaction because there is a discount there. This is the cash weightings in the portfolio. As I said, the cash weightings have come down. They're the blue bars on the bottom, and that's the performance of the market in red. So we reduced the cash at about the right time when the market took off. We've got a lot more conviction in the economy and how things are traveling, and that's a result of our outlook, and it's actually coming through in numbers. So where you see the red line increasing, our cash weighting went down as the market went up. So it has increased a little bit now, the cash, but that's as a result of us exiting a few positions that we took advantage of. Now, if we move on to some of the portfolio investments, we'll just talk about Emco first. It's the largest position in the portfolio. We've got quite a lot of conviction on it.
Yeah, look, when Emco, we increased our holding later last year. We have a lot of faith in what the management's doing. They've made some very good acquisitions. They bought pretty much most of their major competitors. They've given themselves a major maintenance capability across the country, which not only helps their internal mechanisms, but brings in, makes them more appealing to external parties. The company presented at Macquarie. It was a nice, strong presentation. Everything's on track. And the good thing about Emco is they've got enough growth in the next couple of years to prove to the market that it's a strong investment. But beyond that, they have a very lucrative pay down of expensive debt, which will keep the earnings going for another year or so beyond that. So we can see a good 3 years of strong earnings growth out of Emco. And I think the market recovery in resources, the capital expenditure going into particularly brownfields expansion of mines, is playing into their position.
So you can see the share price chart there for Emco. It did have a near-death experience a couple of years ago. For those of you who don't know, it provides heavy earth-moving equipment to the mining sector. And so if you look at the CapEx profile, where it has been and where it's going to for mining, we try not to play the mining companies directly because we find they're quite volatile and we're not great at predicting where commodity prices will go. If we were good at doing that, we'd be, I guess, running a commodity fund or trading commodities. But what we do have certainty around is businesses that supply that sector. So you can see here, with the share price chart, if you look further back prior to 2015, the share price was significantly higher than. So we really sort of bought this close to the bottom. And as Tim said, the company's made great grounds in terms of acquiring competitors, getting better pricing, and they're doing all the right things at the right time of the cycle. So we still like Emco. It's been a very good investment for us, and we'll continue to think that it will do well, especially the announcements they're making in terms of acquisitions, utilisation, and reduction of debt. The next position we've got is CML Group, which is a factoring company. So it provides working capital finance to small businesses. They don't call themselves a factoring business, but that's essentially what it does. It buys, it enters into arrangements with its clients' customers. And so it provides them with working capital. So if you're a labour hire company, for example, you don't get paid for 90 days by your client, CML will give you the money in 25 to 30 days, taking a fee out, of course. But the company's gone, we've watched the company for many, many years. You can have a look at the share price here on this chart. But the first time I met with them was back in 2013. We watched it for many years. We weren't convinced of the business model way back then. They had some very expensive debt. As they started, the catalyst for us to make the investment was they sold one of their businesses, which was a payroll business. And they replaced some expensive debt with bank debt. So that was the catalyst for us that the business all of a sudden was investment grade. They had a large bank debt facility, as opposed to having to go out and issue very expensive convertible notes or fixed interest securities at high rates of interest. And as you can see, the red positive announcements that have come out, we've purchased more shares all the way along, and they've made an acquisition. They bought the FSA Group business, they bought the Thorn Group receivable business, which a couple of weeks ago, and they've announced an upgrade from that yesterday. So things are looking good for that business. It's a company we started buying, around 20 cents, 22 cents, and now the share price is moving up north of 50 cents. So we're very comfortable with the business. It is a small company, but we've got a lot of conviction in management and what they're doing, and they're such a small player. They can gain significant market shares from Scottish Pacific. MacMahon, it's another mining services business that we've got. We've had for quite a while. It hasn't performed as well as Emco. I'm still very convicted on MacMahon. I like what they're doing. I think a lot of the market's still tied up in a bit of negative news about a contract they had at Telfer, where they were losing money. The company keeps reiterating to us that they're not going to lose money. If anything, they're looking at making a small profit from that contract. But it's another one of those companies that was on a near-death experience, and I haven't put the full history of the share price in there, only what's happened recently, but it's had a lot of things happen to it. They were operating in several different geographic regions internationally. They were losing money there. They had a loss-making contract on the Telfer mine, and you start to see here, so early last year, things started to change for the business. They had a takeover offer made for them by CIMIC. But on all of their projects, and this is that CapEx cycle that we like when we talk to management, you know, there's a baseline for all of their contracts in terms of the revenue, and the company thinks that on all of those projects that they're on, there's only upside going to come. So they don't think they'll have any cost blowouts. They think they'll have both margin and contract extensions. So we're very happy with that. I think there's a few people in the market that are skeptical about this Telfer contract. They were losing about $30 million a year on that contract. So that's been renegotiated, and the worst case scenario is they break even on that contract, and the more likely situation is over time they'll start to make money from renegotiating the contract.
Yeah, Alliance Aviation we've talked about before, and it's a good company that acquired some assets, some Fokker jet planes very, very cheaply. It's been putting those to good use, growing in the fly-in, fly-out market, and that once again playing on the recovery of that industry. It also has been doing contract work for Virgin Airlines, which emerged only recently and has already accelerated. The stock has gone into a bit of a sort of a sideways movement at the moment. We let a small amount go at the kind of peak levels, but we're still a good, strong holder and good believer in the company. We have no reason to doubt that they'll keep performing. They'll keep injecting further aircraft into the industry, and also, you know, continue to sell parts. And they're one of the only sort of kind of, I guess, liquid provider of parts in particular jets globally. So that's pretty good business for them. So enough momentum in the story to keep that one going, and it trades on a reasonably low valuation. So we're pretty comforted by that as well.
In terms of where we're looking and where we're paying our attention going forward, these are the sort of categories where we always say that we invest. You know, I like to roll up and roll out in small caps. You've got to be there at the right time while the business is going through that high growth phase. You don't want to be there forever, because quite often those acquisition or rolling stall out models don't work. We love disruption. You know, it's an area where, you know, people can be quite entrepreneurial in Australia. They can have some new technology or some change of business, and we saw it with the ISPs a few years ago attacking Telstra. And so we're always on our eye out for businesses that will do well through disrupting an existing industry. We love owner operators, people with skin in the game. We've got a few deep value situations, and of course the micro caps, which is always quite exciting, the small businesses. So just moving through a few of those, and I won't go into detail in a lot of these because we've had some of these investments for quite a few years. But if we look at this roll up and roll out, National Vet Care is a veterinary practice. We've had an investment in the business since it listed. You know, as I say, we're long-term investors. We're not in and out of things quickly, but you know, when we bought it, it had 32 practices. It's got 60 practices now. I mentioned Emco acquiring their competitors, and it's gone from, you know, having about 300 pieces of heavy earth moving equipment to nearly 900 now. And CML Group's grown the ledger of money that it lends out from 71 million to 112 million. So that's what we've got in that category. And some of them are crossover categories. You know, CML and National Vet Care were micro caps as well when we bought it, but micro caps with a roll up and a roll out strategy. In terms of disruption, you know, we have Afterpay Touch, which provides, you know, it's had a few headlines recently, but it's disruption. And I've always struggled with why the banks aren't more competitive in the credit card space. But a lot of young people can't get credit cards. Afterpay, I'm talking to a lot of young people who are using this because it's just so easy. It's an app you can get on your phone. I signed up for it personally. It probably took me 2 or 3 minutes to get $150 credit. There are risks with the business model, but I think over time they'll improve those risks. But it's very hard for young people without a credit score to get a credit card. So this is a very simple app that they can do. You pay it off in installments. It's the modern day lay-by. You know, and as I said earlier, I've just come back from the US, and it's even harder to get a credit card over there. Afterpay is moving into the US market. Significantly larger market, you know, 330 million people in the US compared to 25 million in Australia. So the opportunity is significant over there. It's even harder to get a credit card over there. And the drive into the US has been driven by their existing Australian clients who've got operations in the US. So I think that Afterpay will do well for us. It's a longer term investment that we've got, but I can see that technology doing quite well. Titomic, you know, I was quoted in the paper on that one last week. It's probably at the riskier end of investments that we've got, but you know, when it started off in the portfolio, it was an unlisted investment that wasn't valued very highly on a relative basis to global competitors, but it does 3D printing of titanium. And you know, there's a significant amount of reports out there that you can look at on the internet suggesting that, you know, all manufacturing that goes on by 2030, you know, will be 3D printed. Not all manufacturing, sorry, 50% of all manufacturing will be 3D printed by 2030. So there's upside there. You know, I did a couple of plant tours in the US of some aviation businesses and some sort of basic industrial type businesses, and you can just see, you know, putting in a 3D plant where, as opposed to, you know, a car manufacturer, for example, going and having, you know, a big steel press, you know, that takes days and days to get right, and, you know, fine-tuning adjustments. You just change the software application, you print a bonnet or a fender panel or whatever it might be, and then the next day you can, you know, change the software, or the next hour, and print something completely different. There's very limited wastage with it, so the uses are quite significant. There's not a huge amount of players globally that can do what Titomic does. Titomic does large format printing. Last week they opened their first industrial size operation down in Melbourne. So look, we like where it's at. It's announced, and the applications are huge. You know, one of the announcements they made last week was for the development of you know, titanium golf heads. So, you know, that's a huge, high margin product. It doesn't cost a huge amount to print titanium product. And the other thing with Titomic is it allows for the feedstock's 40% cheaper than current feedstock that's utilised in the market, high grade. So there's a lot of positive things about Titomic. It was a small position for us. It's done very well for us. And Local Agent Finder is a business that we quite like, which is unlisted. They've done an exclusive deal with CVA. It's where the real estate industry hasn't been disrupted yet. It's, you know, if you look at, compare the real estate industry and real estate agents to stockbrokers, you know, 30 years ago were getting 2% commission, and now you can place a trade. You know, I can place a trade for 7 basis points, and so if you apply that sort of level of disruption to real estate, I think it'll take a while for commissions to come down that far. But Local Agent Finder compares real estate agents on fees and service and things like that. The CEO is the ex-CEO of iSelect, so he understands how to run a comparison business. And obviously CBA likes the business enough to be able to offer it to all of their clients exclusively on their website. So I think it's a very good business. It's in the right space. We've looked at a few of the different sort of players in that area, and I think these guys are sitting in the right sort of situation. But as I said, it's unlisted, so you can't buy that. In terms of owner-operators, Apollo Tourism, we've spoken about before. It's a great family-run business expanding into the US. It's got the Australian distribution rights to things like Winnebago, caravans and motor trailers and things like that. And it's expanded into Canada and the US. Fiducian, you know, the owner-operator there is Indy Singh, owns 33% of the company. He's held the business for a very long period of time. It's a good business and it's a good model. He runs it very sensibly and he makes long-term strategic decisions. And Experience Co, which is formerly Skydive the Beach, which is a tourism leisure business with skydiving, reef tours, and things like that, which is growing significantly as well. So major shareholder there, owning 30%. And the thing we like about this, having these owner operators, is, you know, they have so much skin in the game. If they make a wrong strategic decision, they feel it, you know, in their back pocket. They're not professional managers. They run the business like it's theirs. In terms of deep value, I was very nervous when we first put Shine Lawyers into the portfolio. You know, I was caught up in that sell-off with Slater and Gordon. One of the founders had left the business. That's changed now. The share price has been rated significantly. We still think it's quite cheap and it'll do well for the next, you know, couple of years. And the founders returned back to the business. Noni B, similar situation. You know, it was a family-run business, but you've had new management come in who've got great industry experience, and then they're doing, you know, great things in terms of turning around that business. So they were the two deep value situations. They've both done well for us in the last couple of months, and they're both very cheap when we bought them. Microcaps, I mentioned CML Group before, and Uscom, which is a, you know, very small investment that we've got that's been quite good for us. In terms of outlook and where we sit in terms of how we've positioned the portfolio, as I mentioned, we've increased the weightings in the portfolio. We're reasonably comfortable with things like the mining services outlook and that capex profile for mining services. We can't see that there's any large macro headwinds that are going to sit there in the domestic economy. We have seen increased corporate activity in the portfolio. We've got a position in BWX. For those who watch the market closely, there's a takeover offer announced that a couple of days ago. We've seen the same happen with Tox-Free Solutions, which was a position in the portfolio as well. There is a couple of pockets of overvaluation, small tech stocks with very limited earnings, trading on very big multiples. I think that's going to lead to some pain there when those things have to actually start getting valued on a PE. And as I said earlier, I've just returned from the US, and the US economy is very strong.
Yeah, and look, some of the themes there are interesting. This month in May, we've had a pretty strong month. I think the fund so far is up around the absolute return of around 6%. So we've had some bounce back from some of the stocks we mentioned already, like Titomic, Emco, CML Group. Then Afterpay Touch, BWX, and it's interesting that they're talking about international opportunities, both all Titomic, Afterpay, BWX, angling in on the US. Other stocks we hold angling in on the US. There's a bit of China in our portfolio, but not nearly as much as some exposure to other parts of the world in Europe, etc. So there are Australian companies tend to be doing much better work expanding internationally than they used to. And it used to be an old saying that you just don't invest in an Australian company trying to grow overseas, but I don't think that's the case anymore. I think we've learned a lot of lessons.
Okay, most of you probably signed up to the newsletter, which is how you found out about this, but we are still doing our weekly newsletters and the videos. We have changed the format slightly, so feel free to pass that on and get other people to subscribe so you can keep up to date with what we're doing. We do try to put out quite a lot of information amongst that in the ASX announcements that we do. And so that sort of wraps up the formal part of the presentation. And if I might just sort of call, if anyone's got any questions, that you can sort of type them in there and we can respond to some of those questions. Hold on, I've got one here.
I'm just trying to figure out how to see the questions.
There we go.
There we go. One question, some comments on BWX activity in the last couple of days and some comments on Auto Energy Holding. I can take that one, I guess. BWX, as you've seen, has received a takeover offer from the CEO in conjunction with Bain Capital. It goes back to a couple of slides back where we talked about owner-operators. Well, John Humble owns a large amount of BWX. He did sell some down in the IPO, and so people sort of say, oh, well, he's selling out. But to be honest, he's still a major shareholder. And it just shows you what major shareholders will do to protect their stock. So he's come in and put his money where his mouth is and said, if nobody else wants to buy this thing, I'm happy to buy it. The stock was shorted, I think, up to 19 or 20%. A lot of the shorts were misguided. We were receiving information as to what kind of angles the shorters were taking, and we just didn't accept them. The stock is growing well. It's made some good acquisitions. It had a little bit of a hiccup at the half-yearly result, but since then we've seen the company present twice, and things are on track and performing well. But it may end up being a moot point, but at least the share price has recovered somewhat. It's almost a bit of a reverse of the whole blue sky thing, where an insider wrote a negative report and shorted the stock, and it worked in their favour. Or in this case, the insider said, well, I'm going to buy the company, so it's going back up, and the shorters have to scramble to cover themselves. Auto Energy, one of our few resource holdings, we wrote a piece a couple of weeks ago on Auto. It's got exceptional cash flows coming from some production it's only recently begun to do in conjunction with Byron Energy. The appeal to us is the cash flows are real and they're very, very strong compared to the market cap of the company, and B, Otto's market cap is a long way behind that of Byron, which is a joint venture partner in this project. Byron's a lot bigger market cap and it's the same cash flow. So people will argue, Byron's got a better outlook and it's got more projects coming up, but Otto has that opportunity, and we see Otto catching up when the cash flow is proven, and the market just continues to see the money flooding in, which will give them further opportunity to explore.
Okay, I've got another one here. Okay, so there's another question. Do we hold Zip? So, no, we don't hold Zip anymore. I was cautious about how much exposure we had to financial services and lending, small lending type businesses. So we switched from that into Afterpay, but we also have that position in CML Group. So they're all reliant on getting funding off banks. So we sold out of that. I didn't want to have a portfolio full of businesses that had similar type exposure, but we did very well out of Zip. I like the guys, they built a great business. I just think that there's more upside in the US with Afterpay. I think it's massive. I like the fact they've been pulled into the US by their clients.
On the Royal, keep going.
Any view on the Royal Commission impact on fiducian? Yeah, I'm worried about the impact on the whole industry about practices, because I think that it's hard to tell, if you've got a planner working for you, what's happened and what's happened there. But no, I don't think there's going to be a massive problem with fiducian. I think there's going to be more opportunities to make money out of looking at what happens from the big banks and financial planning aligned groups who are having to sell off some of their operations. So, the compliance costs for these people is going to be significant. So you're already seeing, Westpac. There's rumours that Westpac's going to sell off the Panorama business. CBA's already announced what they're doing. So I think the rectification costs will be huge. I think there's less compliance risks once they do separate, the platform and the product from the bank and the distribution. But I do think where you will benefit and where we're looking for things, and we wrote about in the newsletter last week, is I think that provides massive opportunities for companies like NetWealth and Hub24. I think they're both expensive, but I can see there's massive upside for both of them. Seeing there, I'll try to move on to the next question. Okay, there's one from the discount to the share price. This is for GC1, is around 15%. How are we addressing the narrowing gap, and would you ever consider liquidating the portfolio? Well, I don't think 15% is a massive discount. But yeah, look, if the discount got really big, I'd have no dramas about either buying it all back myself at a big discount or liquidating the cash. But I don't think that our discount's any bigger than anyone else at our size. If there's any criticism we've got, we didn't do enough marketing last year, things like this webinar. So we do 2 roadshows a year now to see some of the larger planning groups that have got funds with us, which we didn't do last year. We're doing the monthly webinars. We still do the NTA. I think if you actually chart discount to NTA with market cap, there's a definite correlation between size and market cap. I can tell you that we do significantly more, and I'm pretty confident we'll do significantly more than a few of the large LICs that have just raised capital. I spoke with one of the principals of one of them, and he said, Mike, I'm not going to do any marketing at all. So I think just getting it out there and performing over time, it'll look after itself. And it's an efficient market. So there's a lot of people watch the stock. If it gets too big a discount, I think people will buy the stock. But yes, I'd like to see the share price over $1. But as the NTA increases and we keep paying out the dividends, I think that the share price will follow the performance. What's your opinion on VTG?
I'll answer that one if you like. Vita Group, we did have a modest holding in Vita Group, and we were basing that around the recovery in both the Telstra-related business, which is by far the biggest part of the business, and we believe that they will recover. I think they went through some bad moments, and I think Telstra have sacked all those people, and they're kind of back on track. Telstra itself has a problem, so there is a macro overlay which is reasonably negative, even though the technology and the communications market's still strong for Vita Group. But it was interesting that in the last, when we met the company most recently after the last results, the focus had switched almost 100% onto this non-invasive medical processes and the accumulation of businesses and the sort of nationalisation of a sort of a chain of businesses under Maxine's guidance. Now, Maxine's a very, very good retailer, one of the best in the country. I've got no doubt she'll get there eventually, but I think the extreme focus on that business meant that even the company's probably losing a little bit of faith in the Telstra business and in the future that they have with that, and that therefore the onus on the growth of the business going forward in the longer term is on this medical business. And I think it's just too early for us to commit. So we've exited Vita Group, and we'll keep an eye on it, and we may get back into it at some stage. But right now, I think it's just a bit too early for the medical business, and there's enough doubt on the Telstra business to sort of leave it alone for the time being.
This question about Dropsuite. Look, very simply on Dropsuite, I think we probably invested in the business too early. I've got a lot of time for Theo Hernakis, who's on the board, who was the former CEO of Melbourne IT for a very long period of time. Theo's an excellent operator. He's very well connected, and I'm very enthused about the CEO's passion and enthusiasm for the business. But I just think it was a little bit too early, but I still think that they're in the right marketplace. So for those that don't know, Dropsuite offers a range of products for small businesses to back up their emails and websites and things like that. And speaking from experience, we got hacked 2 years ago. I didn't have a backup of the website, and it's a drama when it happens. And I think there's a big place for small businesses to get a little bit more savvy with their IT. I think for us, in terms of the investment, I think it was a little bit early, but it's a tiny investment for us. But look, we'll be patient and see what happens there. You've got to put a bit of risk into your portfolio. It's a very leverageable and scalable business model. There's another question. Have I measured the beta of the portfolio? No, look, I don't waste my time measuring the beta of the portfolio. And many years ago, I wasted a heap of time trying to calculate betas of individual stocks and betas of the market. But the market's not that liquid in small caps. So mathematically, the whole thing doesn't work out that well. It works for big cap liquid stocks, calculating stuff. But if you've got big bid offer spreads and the last price and the volatility in stocks, and you have a look at it, it's not a perfect data set for small caps. So, but no, I don't worry about it. Trying to buy businesses. And I'm not sure what it would show me, the beta of the portfolio. We calculate a few things for a couple of institutional clients, but that's not one of the things that I look at or worry about so much. The second insight was on Paragon Care, an update. Well, we've exited our position in Paragon Care. I think there's a change of CEO in the business, and that was a bit of a trigger for me to get out of the business. We've done well out of the investment. I think things had changed. I was concerned because you've got a professional CEO coming into the business. I'm still waiting for the phone call I had from the CEO for him to call me back and organise the meeting. He said he'd call. So if I can't get good information out of the new CEO yet, I can still get the old CEO on the phone regularly. So yeah, look, it was just enough for us to move on in that industry. I think there's a lot of hard work. That was a roll-up strategy. But look, we're not there at the moment. We still keep an eye on it, and it'll be interesting to watch because that's another space where there's massive opportunity to consolidate the industry. But for us, I want to see the new CEO. I don't know. I just don't have enough information to make a good assessment of someone who's come out of a big business and gone into a little business and doesn't have a lot of skin in the game. All right, that looks like the last question. If there's any more questions, just enter them in now. It's very hard for us to read these questions on here, but there's a lot more questions. All right. We've got, no, we're not holding MSL Solutions. It was a very small position. I got out of it. Yeah, I think that was probably another business that was too early, and that happens sometimes. After spending a bit of time with the guys, I think it's just a bit too early for us. And I think that's an important thing, recognizing when you've made a mistake in getting out of something when you can get out of it. Are we invested in Smart Group? No. RCR, no.
Money3, yes.
Money3, we have some in the, yep. And Money3, yeah. So no, that answers that question. Smart Group, no. RCR, no. But we still have mining services exposure, so we've switched that. We've got quite a lot of conviction. If you see something better, it's always better to sell one of your existing investments if you think there's more upside in something else.
One area in that related to that, we'd like to find the right exposure at the right time is sort of into the East Coast infrastructure. RCR's really gone down the solar construction of solar projects, and it's getting some big ones, and that can be, I mean, you talk to a lot of players in the market, it can be a very fine margin business, and you get one project wrong, it can ruin all the rest of your earnings. But we'd love to find, we've got a few ideas and exposure to that East Coast infrastructure build, but a lot of the stocks have kind of stalled. They haven't really got going. I think the market's still waiting for real proof of the penetration into that market and the earnings outcome. There's a lot of talk, and there's a lot of people saying it's happening, it's coming and all that, but we still haven't found the right vehicle yet.
I'm just going through the last of the questions.
Small amount.
Yeah, and the last question here, I'll actually just sort of cut it off after this, but am I happy with our staffing levels to handle such a large number of microbes? Yeah, I am, because there's I think there's only about 700 companies that you can get out there, and I can hire 20 young kids to come and sit in the office and have a really big staff number, but they're going to lack experience. And the other thing is, I've run big teams before, and it becomes management by consensus, and one guy doesn't like the stock and one guy does. You've got to have individuals that like a stock and back the stock. So, but look, in terms of overall resources, the business is pretty well resourced. I'm out there. I've been doing it a long period of time. There's a lot of business models I can look at, I know just don't work because I've seen it before. Same with Tim, he's been around for a while. So you can filter out a lot of those companies, either it's being too early, or a lot of stuff, if you've been doing this for 30 years like Tim has, or 25 years like I've done, there's people their track record and they haven't delivered stuff, so you can get rid of a lot of those people straight away. If you do a quick filter on the market and you take out all sort of speculative resource stocks that have got a guy with a shovel out there saying I think there's gold out there, or next week you're saying I think there's some lithium or cobalt or whatever it might be, you can get rid of a lot of those things. There's some businesses where you just don't trust the CEO because they haven't delivered in the last 3 or 4 businesses that they've been in. So the opportunity set gets actually quite small once you get down through some of that stuff. And then when you see new opportunities, you get a feel for whether it's going to work or whether it's not going to work. And we do get some of them wrong, but we get more right than we get wrong.
The other element is our portfolio is only a bit over 30 stocks at any one time, maybe between 30 and 40 stocks. If we assume we invest in most of those for the long term, there's only a few ever that we should need to replace at any particular time. So we're not rushed into our decisions. We can take our time, and then when we find a good story, we can really follow it through and then make a decision on, do we drop another stock or do we throw it in and we've got a bit of spare cash. And so it's not desperate that we have to filter every micro cap every day.
Yep. All right. Well, thanks for listening. There's a couple more questions coming, but yeah. So thanks for listening to the webinar. We will announce a copy of this. We'll put a copy on YouTube, and we'll announce this to the ASX and put it in the newsletter on the weekend. And you can, if you go to our website under events, you can register for the next one, which will be the next quarter. So thanks, everyone.
Thank you very much, and we'll keep the concrete quarry business idea up in mind. Thanks for that one,
James.
James. All right, thanks, guys and girls.